Episode from The Simple Investor, where each video I show you how to identify great stocks to add to your portfolios and how to highlight the ones which need to be overlooked and put in the bin. I'm here for simple advice, avoiding the technical jargon and making sure people are making the right, simple decisions to make good investment decisions. This week I've got a really interesting stock for you. For those who are interested in earning a passive income, money while you sleep, money for doing nothing whilst you're sat there watching Netflix on the telly, you can be earning money if you have a piece of this stock. It might not be for everyone's portfolio, but it's one that I feel it warrants research and warrants a video about it. So how many of you have sat there and thought, oh, I'd love a bit of passive income on the side to pay for that holiday, to upgrade the car, to upgrade the house. If you've got a portfolio big enough and a portfolio robust enough with these types of stocks mixed into it, you can be earning a lovely little passive income alongside your current or main income that you receive. So as you can see, I've got an aeroplane in the background. Before I get into that, if you are enjoying my videos or are new to these videos, please hit the subscribe button now. I'll give you 3 seconds to do it. Great, I assume you all did it. If you are enjoying these videos, please do subscribe, please do like, and also just leave some comments. I think it'd be really interesting to hear your thoughts on the stock, and also any other stocks that you'd like me to take a look at. I think that could be really interesting to engage with what you are looking at and see what my opinion would be. I mean, ultimately, I'm here to make simple decisions as to whether I want a stock in my portfolio or not. So let's not waste any more time. Let's jump into this stock. This video is about Doric Nimrod Air 2 Limited, or DNA2. This is a Guernsey-based company that incorporated in 2011, as you can see here, and it's trading on the London Stock Exchange. The company specialises in the leasing and selling of aircrafts, and as you can see, it has a portfolio of 5 Airbus A380, A61s on long-term, all of which are on long-term leases to Emirates. For those of you who are unaware of the A380 or have never flown on one, this is what it looks like. It's one of the big aircrafts, one of the bigger aircrafts that is quite impressive when you see them take off and land, and if you've ever been in one, the insides are absolutely spectacular. So what is it about Doric Nimrod Air 2 Limited that's caught my attention? Well, first things first, I like to keep my portfolio decisions simple, and usually for stocks I don't rely solely on dividend payments as an indicator for a good stock. I think there has to be a whole picture of funding and consistency and growth, and if that results in a dividend and consistent dividends, then great, but it's never the be-all and end-all for me. What I do like to do every now and again to mix up my portfolio and diversify slightly is to have those stable dividend payers alongside the consistent growth stock, so you are constantly earning a passive income and generating a little bit extra funding on the side to grow your investment armory and the funds you have available to you. So if we dive into the financials here, I put up simply Wall Street. I've spoken about it enough on my other videos, so I won't go into this now. But what we have here is the graphic, which shows generally that it's a healthy, consistent company with a good dividend payout. The future, don't worry too much about that. That's whether there are analysts covering the stock, and we don't need to go into that so much, because what we're looking at today is a stock that is going to pay us consistently without the potential to overpay and run itself into any trouble. So I guess naturally then, the first place to have a look is what the stock price actually is at the moment. I've put it on 5 years here so you can see a history of it. We currently sat trading at £1.24, which is the latest price that Simply have. I never use that for current prices, but generally this is what it's roughly looking like. I thought it was useful to show you the 5-year pullback on it because most of the time, if you have a spectacular drop off in a share price, there's a big reason for it, and you kind of want to know why. I mean, most people will be aware of what happened around February, March 2020 time, and that was when obviously the devastating COVID hit. And it's devastating for a number of reasons on a humanity level, but also industries that were hit the hardest and sectors that were hit the hardest include travel and air flight, which was quite literally ground to a halt. And this company, DNA2, being heavily involved in leasing and selling of aircrafts, obviously took a lot of beating from the COVID period, and that can explain that sort of share price plummeting. And then from then you can sort of see as the industry and the market and economies start to recover, we've seen a fairly consistent growth in stock price up until 124, which is the 28th of May. So that's just a little bit of a background of the stock. If anyone was looking at this and thinking, God, this is way down on where its previous highs are, you've got a little bit of a safety belt there. So the next place I like to look at, before we get into anything about dividends, before we even look at what the dividend payout is, it's not all about rushing to see what a company is going to pay you each year, because whilst that might be great, you want to make sure that money you invest in that company is going to at least hold its value whilst you receive those dividends, because there's no point putting £100, say, into a company to earn a £5 dividend a year if your £100 at the end of it is then worth £40. You might make the £5 each year, but you've lost a hell of a lot more in your investment. So it's key that you look at the financials of a company before going straight into the dividends to make sure that the share price can be stable and that it has assets and a good, healthy balance sheet in place to justify its dividend position. So jumping into the balance sheet then, we have tick, 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 tick from Simply Wall Street, and I think I'll articulate that a little bit better if I scroll down here. We've got total assets, short-term and long-term, of 283 million. That's split up of 93.81 short-term, 189.74 long-term. And as you can see here, that quite comfortably covers the short-term liabilities and quite exceptionally covers the long-term liabilities, which is great because the usual test as well is what you want to also look at is whether short-term liabilities, which encapsulate more liquid assets, i.e. short-term less than a year, so they're more liquid, you can dispose of them or get rid of them or spend them in a much faster way than you can a long-term asset, which is how they're classified. And you need those short-term assets to be able to cover any debt payments that are due. And as we can see here, from liabilities of 4.3 million, 93.81 million of short-term, it's pretty excessive and comfortable with that. And that's sort of summarised below there. So if we scroll down to take a look at the balance sheet breakdown, we've got cash and short-term investments of 33 million, receivables of 2.5, and all compared to a very healthy debt of 5.4 million pounds, which a lot of green, keeping it simple. The more green, the better, but diving into it a little bit deeper, you can see that that is a healthy balance sheet and something that investors, especially investors looking for dividend payouts, should make themselves aware of, because can the company afford dividend payments on a consistent basis? And whilst the debt might indicate that they're not necessarily looking to expand, because often companies need to utilize debt to grow, that's not what we're necessarily looking for in this case. What we're looking for is the cover, the dividend cover, if you like. Have you got enough money in the bank to pay your shareholders that consistent dividend, and I think here we can quite comfortably see that it has. I think what's also interesting here is the company's strategy. If we look back to 2013, June 2013, the company was actually had a lot more debt than it did equity, and over the years it's worked well to reduce its debt and bring that in line with its equity at around 2019, and then we can see the current position is a lot healthier, where it's only got £5 million worth of debt and £214 million worth of equity. So it's in a comfortable position as of now, and the balance sheet does just deliver that snapshot of a company's health, if you like, and that's why it's labelled health here. Okay, great. So how will that continue moving forwards? Is this still a dice roll? Can the company continue to deliver its dividends at a consistent rate? I think it's always important to look at what the company's done historically in terms of revenue, so you can use that as a basis to look at what it's going to do in the future. And whilst that's never a guarantee, it gives you a pretty solid indication a lot of the time. So let me just clear this up a little bit and start with revenue. So we know the company's got 5 Airbuses, which I think can be used to explain the fairly stable progress of revenue over years. I mean, you'd like to see a revenue continue to go up, but because the company essentially only has 5 products and is leasing those, you'll expect that that's going to stay, if they all stay leased out, unless they get another plane, then you wouldn't expect revenues to jump significantly. And I think that's clearly it's sort of displayed with this almost straight line of revenue. Whilst it has grown slightly, I think you can put that down to costs more than anything else. Another thing to look at is earnings, just to see whether the company is earning money. Now, this is quite an interesting, shall we say, roller coaster of earnings. I haven't gone into why each year is different, and I don't necessarily think you need to worry too much, particularly because the times that it has gone into debt was quite a long time ago. You're looking at 9-10 years ago, and it's pretty quickly recovered from those times that's happened. So you can assume that there were big one-off costs potentially in those years. The years where it's slightly more consistently in making a loss is over that COVID period. So whilst you can't discount it, you can caveat it quite heavily. So that's a look at its history. So now what we've all been waiting for is, how does this stock pay its dividends? What is its dividends like? So if we jump down to the dividend section, we can go to, let's go to here. So this is a stability and growth of payments, i.e. the dividends chart and graphic, which I think is really, really interesting. I mean, if we just start with the very basics, you can see here from July 2014 through to 18th of April 2024. Across that period, dividends have remained exactly the same, completely consistent, no fluctuation, even across that time in COVID where losses were being made. The company had that balance sheet and health safety net, if you like, behind it, which enabled it to continue to pay its shareholders. And whilst you might say, okay, well, dividends haven't grown, we've explained that revenue is not necessarily grown, and this isn't a growth stock. I don't think this is a stock that's not going to give you a massive capital appreciation. This is a stock that you might get a little bit as the economy recovers, and in the future it might invest in new planes, etc. But this is a stock really, if you're looking at it from consistent payouts each month, each date of dividend, either interim or final, this stock delivers up for that front. And guys, how many of you would love a dividend check just going into your bank account or into your stocks and shares ISA or whatever you're using from this company, and just growing your money without doing anything? Just purely by owning this company, you can make yourself some money. So to me, this doesn't sit in the forefront of my portfolio, but what it does do, keeping it simple, is there a consistent level of dividend payments? Unequivocally, yes. Does it have the balance sheet to support those dividend payments? Absolutely, yes. Has revenue been stable, growing, or at least consistent over its lifetime? Absolutely, yes. So we've been through 3 very key criteria for me to assess whether a stock is worth purchasing for that reason of dividends. So if we just look at some of these numbers, it might be quite useful. So we've got the dividend yield here, 14.5. If we scroll down, I want to see, and here we go. So the dividend yield compared to the market is a lot higher. So if we look at the industry average, you've got dividend yield of 14.5% compared to an industry average of 2%. So this is one of the biggest dividend payers in its industry. And that's useful to know because it's a success. This will tell you that its priority and its focus is a return on investment for its shareholders. It might not necessarily be for absolute growth, which every company needs to grow, but its focus is on attracting investment and rewarding those who put money into the company. So if we keep scrolling down, there's some more interesting metrics as well. We have earnings to payout, so earnings coverage, which is what percentage of earnings is paid out as a dividend, and there you've got 46%, which simply Wall Street likes, but I mean it just says what it is. 46% of its earnings each year are paid out as dividends, and that means 54% are retained as earnings in the company, which can be used or kept as cash or used to invest or whatever it wants to do. The next is, can it cover it? And with its cash, we've seen the healthy green balance sheet. So yes, with its sort of cash flow, the payments of dividends only take up 30% of its available cash flows, which is a very small margin. So even if that fluctuated, doubled, tripled even, it might squeeze it in extreme circumstances. The company can survive it. And we've seen it survive COVID, which spectacularly destroyed the aircraft and travel industry, and it still maintained a solid, consistent dividend. So what I would encourage you to do, guys, is take a look at this company for yourself, see if it fits your portfolio. You've seen it's a healthy company, you've seen it's consistent with its dividends. It's got a tick from me if that's the sort of company you're looking for. Please do give this video a like if this has been helpful, and do subscribe if you want to see more videos. I'm not just looking at growth stocks, I'm looking at dividend stocks. I'm looking to accommodate simple investment strategies for stocks and UK stocks, and wider than that for people of all types of portfolio. So if these are useful to you or you're growing a mix, please do subscribe. It will be much appreciated. So I'll leave you with that. I wish you all the best in your investments, and keep it simple going forwards, guys, and I'll see you soon.